Hello Sector Watchers, welcome to the show. This is the 107th episode of Sector Spotlight for Tuesday the 7th of December, recording it on Monday the 6th. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands. If you have anything to share, any feedback, please use any of the handles on the screen. I do have a little bit of a backlog in answering, but I'll do my best to get back to you, let's say before the end of the year. I think that should be doable and probably reasonable. For today's show, my plan is to do a thorough review of asset class and sector rotation as we saw it last week. See if we can put that into a little bit longer term perspective. But after that, I would like to go back to the sector rotation model as it was presented by Sam Stovall many years ago. We've discussed that model here in the show before. It's been a while that we picked it up. But I have the idea to take the offensive, defensive, sensitive breakdown of the sectors as we've been talking about and I've been presenting about over the last few weeks. Take that breakdown and bring it onto that sector rotation model and see if we can pinpoint where the market is based on its current rotation in combination with some of the macroeconomic factors that influence that business cycle. So first, actual rotations, and then move on to longer term perspective and put it into the sector rotation model and see what we can learn. Kicking off with the rotation for asset classes, we have the daily RRG on the right and the weekly RRG on the left. And if we start with focusing on the daily version, we can see that last week was pretty much a risk-off week. The fixed income asset classes, high yield, corporate bonds, government bonds did relatively well, while the stock market ITOT actually moved from weakening into the lagging quadrant, not surprisingly following a few very weak days in the market. Both commodity tails, DJP and GSG, rotating on the left hand side, they're going through a little bit of a bigger correction, and you know, we'll put it onto the weekly in a minute, but this is for the near term. Commodities are a little bit out of favor, and I think we need to start watching for a new potential entry point to participate or re-participate in the longer term turnaround that's going on. The strong asset class, the strong rotation for the US dollar continues. Last week it lost a little bit on the momentum axis, but it continued to gain on the relative strength ratio, so on the relative strength scale, which is good, and that longer term move seems to be intact and underway. If we put all of that onto the weekly, then we see a slightly different picture, because I think that the longer term trends, as we've discussed them before, are still there. We start with the tails for commodities on the right hand side, then you can see that they are still inside the leading quadrant, but over the last 4 or 5 weeks lost relative momentum, which is not surprisingly because they have made a very long rotation, and so they're blowing. I think it's just a matter of blowing off a little bit of steam. So with the weeklies here on the high end, as you can see on the weekly RRG, this rotation on the left hand side, which is clearly causing that loss of momentum here on the weekly, for the time being I'm interpreting that as a pause, as a temporary setback within a longer term uptrend that's emerging for this asset class. For the US dollar, both tails are actually showing quite similar movements. Still moving to the right on the RS ratio scale, which is good. It's picking up versus the benchmark. A slight loss of relative momentum, which is also not very surprising given the steep rally of the US dollar over the last few weeks. So I remain fairly bullish for the move of the US dollar in the coming weeks, I should say. And also, if you look at the rotation for ITOT, for the stock market, it's inside leading. The last bit here and that was from Friday, so that last week is slightly weakening, but the direction of that tail is still pretty good. And the same goes for real estate, picking up inside weakening, so it seems underway to pick up a new uptrend in the relative uptrend that's already in place. So I should say a new up lag in the uptrend that's already on the way. And the cluster of fixed income asset classes, as you can see here, all inside the lagging quadrant, going through a little hiccup. That's the positive move that you see here on the daily, but they're still too far away for this rotation here to be very meaningful on the weekly RRG. Let's quickly move to a couple of price charts that belong to these rotations, starting with the US dollar. And here you see that rally that's underway. You know, still very much intact. It could even go down to, I don't know, 95. It won't hurt this uptrend that is currently underway. Near term, I think 97 is the level to watch. If you break 97, we can actually move a bit higher. If we do that on the daily chart for the euro dollar, then you can see here that breakdown, a little bit of a rally we've seen, almost reached 114, and we're now, looks like we're now moving lower again, and that 97 in the dollar index is actually equal to 111.86. So 111.86, 111.85. If you see euro dollar drop below 111.85, I think we can see another acceleration lower, which means more strength for the US dollar. If we quickly go to the chart of the stock market, we'll look at the S&P later on, then you see that uptrend, it looks as if that trend channel is slowing down in pace, but it's still going higher. So that rhythm of higher highs and higher lows is still there. And the same goes for the relative strength versus VBI/NX. The uptrend is still there, albeit at a slightly lower pace. But you know, after about a year of a strong rally, we're now slowing down the pace for the last 5-6 months, and this can continue for a very long time. You see the effect here in the RRG lines that are again now both above 100 and slowly moving higher. As long as they stay in this constellation, then it's all good for stocks, and we continue to prefer stocks over bonds, which you can clearly see here with ITOT on the right hand side of the graph and the fixed income tails on the left hand side of the graph. I'm going to wrap it up here for the asset classes, and we're going to go talk about sector rotation. Moving to sector rotation, we see a similar picture in the sense that it was a risk-off week. We can see sectors like staples and utilities doing really, really well. They're showing up here in the top of the list over the last 6 days, so that's Monday to Monday, including Monday. Today's performance is already included. And what we see is that despite the fact that well, at least in my mind, it was a bad week for the stock market last week, it was actually a pretty volatile week, and that translates into my mind as a bad week. If you look at the performance over the last 6 days, it's flat, 0.0. But the differences between the top and the bottom sectors show that it was risk off, because the gains were actually made in utilities, staples, real estate not so much, and then you go to industrials, energy, and then all the way down you see discretionary and communication services. Healthcare, supposedly a defensive sector, not very good, which is mixing up the whole pattern. So for me, that means that it was a risk-off week, but I don't see a very clear risk-off trend. And that is better visible if we go to the left-hand side on the weekly RRG, because there we see that a sector like discretionary is still deep inside leading and continues to move higher on the RS ratio scale, losing a little bit of momentum over the last 2 weeks, but nevertheless still one of the stronger sectors. Same goes for energy, very strong sector, deep inside leading, but losing relative strength. And then also technology, which is basically just crossing back into the leading quadrant after a rotation from leading through weakening and now back into leading. And if you see where technology is here on the daily, it shows up with a rotating tail, a move down, rolling over. But even on the daily, based on the RS ratio, if you measure it on the RS ratio scale, still the strongest sector here on the daily. So I think those alignments mean that we're still pretty cool with the rotation of technology as it is. The financial sector is very close to the benchmark, lost momentum undeniably over the last few weeks, but week-to-week observations very close together, which means that it is a stable trend. It's on the right-hand side, it's an uptrend, and it's very close to the benchmark, which means that it's an uptrend, but it's not, far away from the benchmark. Interesting rotations continue to show up for materials and industrials, with these tails improving and moving at a strong RRG heading towards the leading quadrant. And then what do we have here is staples, just like we had financials on the right hand side with a short tail. Here is staples on the left hand side with a short tail, but much further to the left. So that's a really stable relative downtrend, and that's a very defensive sector. So the longer term picture is pretty much still showing us a risk on characteristic, risk on constellation for the rotation of the various sectors. If we look at discretionary, I already told you about that. Healthcare, one of the defensive sectors, still inside leading, picking up a little bit, but not much. And then the real underperformer is communication services. It's a long straight line deeper into the lagging quadrant. No outlook whatsoever for an improvement, at least not on this weekly RRG. And only if we go to the right hand side to the daily, there's a really small hiccup of Friday and today, because remember, this includes today's price action. This is until Friday, and this is including today. And if you measure on the RS ratio scale, it's the weakest sector on the daily RRG, and it's the weakest sector on the weekly RRG. So that says something. I think it's definitely a sector to avoid at the moment. Let's go and put this into, no, let me do something different. Let's move to, I want to go to the breakdown of offensive, defensive, sensitive, and I will try to merge that into my discussion on the sector rotation model. But I also want to bring in a few of the sector charts, the price charts itself. So if we go to the cyclicals, then here is the set of cyclical sectors. And as you can see, except for financials, their tails are all pretty much moving to that top right-hand quadrant. Real estate inside lagging, but starting to pick up, and financials still on the right-hand side, but losing momentum as we've seen. If we bring that onto the price charts, then we see here for materials, the bottoming, the transition process for the sector in terms of relative strength is clearly visible. We do need an acceleration. I'd like to see this breaking above this resistance here, but the improvement in both RRG lines is clearly visible. It's a bit of a disappointment that the sector wasn't able to hold up above the breakout level. However, if we can put in a higher low here and do a new attempt, that could help fuel that improvement in relative strength. If we go to the discretionary sector, really quickly, that's the last one in my list, then you can see that the breakout is still there, and we're now sort of hovering on top of that old resistance line. That seems to be coming back as support now. We'll have to see if that holds, but it coincides with the relative strength moving into resistance at levels that we've seen at the end of last year and the start of this year. Again, if a new rally can push this relative strength to new highs, then you can be sure that this tail here continues to move further to the right. And you can see here that the RRG lines are comfortably above 100. The only thing is that that RS ratio line is relatively high. If you compare the historical levels of that RS ratio line, we're at high, so maybe we need a little bit more of a correction. Mind you, that doesn't have to mean that we're going to see a rapid decline in price, because you can also get a a consolidation over time, and you digest the rally over time. It just means that the market needs a little bit more time. If we go to financials, that one is here, then we see that the pace of that rally has been slowing down. We're testing the lower boundary of that still rising trend here, and relative strength is struggling. I'd like to see this hold above that support level and eventually break to new relative highs here. But as you can see, of these cyclical sectors, financials probably the weakest one. We go to real estate, then you can see here that we're pushing against resistance. We also need to take out overhead resistance and relative strength, and that will eventually push both RRG lines back above 100 and complete the rotation here back to the leading quadrant. But all in all, the cyclical sectors are still in good shape. If we quickly move to the defensive sectors, then they're all on the left-hand side, as they have been for a while. You see the recent pickup in relative strength and momentum, but it is all taking place far to the left-hand side of the RRG. So they remain the weaker part of this whole sector universe. The defensive sectors continue to be the weaker ones. I think that is clearly visible. And if we bring in the price charts here, and we go look at a sector like staples, which is just about inside the improving quadrant here, and you can see that it is inside an uptrend in terms of price, no doubt about it. It's pushing against overhead resistance in that, let's say, 73 area, and also in terms of relative strength, it's pushing against an old support level that's now acting as resistance. We definitely do need a lot more in terms of price, followed by relative strength, before this sector will really become a leading sector again. If we go to healthcare and utilities, and let's see, the utilities is the first one, then still below overhead resistance. The trend is up, but it's at a very slow pace, and that means that compared to the rest of the market, you see relative strength coming down, and over the last few weeks leveling off. So the pace, the negative pace is declining. It's not as bad as it used to be, but it's still not a fantastic sector, which is to be expected with a market that is in risk-on mode still. And finally, the healthcare sector, that is back into its rising trend channel. So we saw the breakout, we dropped back. I told you that when that happens, you often see a decline back to the bottom of the range. That happened, and now we seem to have put in a lower high. That's a negative in terms of price for the healthcare sector. So the rising trend line here should now hold to keep that trend intact. But we see the problem here in relative strength, where we're challenging the lows that we saw in April this year. Both RRG lines well below 100, pushing the sector into the lagging quadrant with a little hiccup of momentum over the last few weeks. And finally, we have the sensitive sectors, and those are the ones that are usually tipping the scales. And one message is very clear, and that's the weakness of the communication services sector. That is the clearest signal that you can get. Communication services is really the worst sector of the lot at the moment. Energy, very long tail, still well inside the leading quadrant, losing relative momentum, but still very strong. Technology, we already discussed it with the overview, rotating back, that's all pretty good. And industrials are pretty stable, just used to pick up. Not a lot of power. I mean, this is not a very long tail compared to the others, but it's very stable at a very nice RRG heading. So that's the overview of sector rotation as it stands right now, with a little bit of a look at from a longer term perspective. And for the last segment of the show, I want to try and see if we can get all this information wrapped up in the sector rotation model and see if we can find any alignment. Just to refresh your memory, the sector rotation model is a model that was developed by Sam Stovall many years ago. He wrote it in his S&P Guide to Sector Rotation. Highly advised to pick up that title and give it a look. It is a traditional cycle model that positions the sectors on top of the economic and the market cycle. So the orange one is the market and the blue one is the economic cycle. And as we all know, the market leads the economic cycle. That's the whole theory. The table below is maybe just as important as the information that we want to put on the model for the sectors. These are a number of macroeconomic factors that influence the business cycle. And I actually have a chart list with those 4 factors, 4 charts that are important to interpret this sector rotation model. If we quickly go over all 4, this is the consumer sentiment index, consumer expectations, and that is now definitely declining again. And as you can see in the table, a declining consumer sentiment index means that the market is in full recovery. If we go, or suggest that the market is in full recovery. If we go to industrial production, I think we can safely say that it is rising. It's still on the rise, and that means that we're in early recovery. If we go to interest rates, that's debatable. Bottoming out, or is it rising, or is it fast rising, is it rapidly rising? I think it's somewhere in the middle. So early recovery, full recovery. That's my take with regard to interest rate movement. And the final one is the yield curve. That is now coming down again. That's flattening. Rising means steeping. Coming down means flattening. It is normal because it's a positive number. That's a normal yield curve. So here also, I think we're somewhere between early recovery and full recovery. And I've tried to put that on a chart to make sense of it and include the positioning or the take on the various sectors. So here's the same chart. And if we start with the macroeconomic factors as we just spoke about them, I think that consumer expectations positions it in full recovery. Industrial production puts it in early recovery, and interest rates and yield curve are probably somewhere in between early recovery and full recovery. In terms of the market, that means somewhere here. Looks like a market top or on the way to, because I think we're more leaning towards the left, and that's because of the position and the reading and the take on the various sectors. Now the color codes here are green for defensive, red for offensive cyclicals, and orange for the sensitive sectors. And I think that from the RRG we can safely say that the defensive sectors, so the green ones here, are now underperforming. If the market were in full recovery or over a market top, these would be outperforming. That's not the case. So I think we're definitely not here. Now, real estate and financials, I think we could qualify them as early cyclicals. They seem to have had their rotation. If you look at the RRG and bring them in, then you can see that financials are here and real estate has already made a move. So they already had a pretty good run. If we look at discretionary and materials, they are materials on the run and discretionary already there. So that's debatable, but they are still doing pretty good. And then come the sensitives, which is the ones that are tipping the scales. And really the only odd one out here is communication services. So technology, industrials, and energy are still on the right-hand side. They're doing really well. So my take on all this is that we are somewhere here with communication services being the odd one out. That's a debatable positioning. So all in all, I think that based on the sector rotation model, based on the current rotation of the sectors and the macroeconomic factors, we are somewhere between early recovery and full recovery, more leaning to the early recovery side, which means that we're still good. Not at the beginning, moving towards the end, but the trend is still there. Ladies and gentlemen, we need to wrap this up. Thank you for watching. This was Sector Spotlight for this week. I hope you enjoyed the show. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern here on StockCharts television. And I hope to see you again next week, same time, same place.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.